Where's all my soul sisters? Let me hear your flow, sisters.
Hey, sister, go, sister, soul, sister, flow, sister, hey, sister, go, sister, soul.
Hey everybody, welcome to this episode of Soul Sistas. Today we're going to go ahead and take a dive deep into lending. I'm Amanda Zuniga.
I'm Heather McKitty, and today we have a guest speaker, Jason Twitchell.
Hello. Thanks for having me, guys.
Yes, thank you for joining us. Can you tell us a little bit about you and what you do?
Well, that's a long story. But I am a mortgage lender. I've been in the business since 2001. Worked for some big banks, some brokers, some small independent mortgage companies, and kind of seen every aspect of the mortgage business. So what else do you want?
Currently?
Currently with Granite Bank, a small company out of Minnesota, and we do some portfolio products, some broker products, and some correspondent type products.
Awesome.
Yeah,
Very nice.
big gamut.
Thank you.
So I think one of the topics anyways that we want to cover is why it is so important to choose a good lender. And you've been doing this for how many years again?
Since 2001, so a long time.
A long time.
Yeah,
So
20 some years.
That's amazing.
So we've
because
seen
it is
big iterations. So back from the subprime days to the crash, to the tightening after the crash, and now to things starting to open up a little bit from a credit perspective.
yeah.
So what does a strong lender bring to the transaction?
Well, that's a great question. In that 20 some years, I've seen just about every scenario that you can run into as a real estate agent, right? So whatever credit profiles, whatever purchasing profiles. So we'll use your example. I guess we can talk about that one.
Yeah.
How far were you guys from trying to close?
Oh my gosh.
You were
it was
under
like
contract for how long?
Oh, we were under contract for about a month.
For about a month.
It was going on a month. We're supposed to close around 30 days, and we were like a few days from closing.
So you spent probably
28
spent a good 30 to 60 days showing them houses, trying to get them into something, and then another almost 30 days under contract with somebody. And you found out at the last minute that they couldn't use the product, or any product for that matter.
Yeah, I was
that they
devastated.
Yeah.
Actually, I was devastated for my client. It was terrible.
I would say that's probably the biggest reason you want to use somebody that is experienced, because the last thing you want to do is deliver bad news. All of us are around the board. But they moved. They probably spent a lot of money on appraisals, on home inspections, on moving expenses. So it's not just I got a bad lender. I had a bad experience. It's a lot of money.
Too, because he gave notice to his apartment. So I'm like, sorry, we already rented out. You still got to move.
Exactly.
It was terrible.
It is devastating all the way around. So that's what I would recommend as you're out there shopping. There's a website, NMLSconsumeraccess.com, and you can go back and check the 10-year history for every mortgage lender. I would recommend checking out every license number to see what their experience level is. We have to report at least 10 years back. So I used to do classes, and I would show some of those. Nothing against it. We all started somewhere, right? But I would see these histories, these resumes where they were currently still unemployed, pizza delivery drivers, or tow truck drivers, and still doing mortgages. And not that those are bad things, but when you have somebody's entire life depending on whether or not you're getting good information, and usually when I looked them up, it was because somebody was getting bad information. So that is
or just not really doing their due diligence up front, right?
Yes.
And because that's what you learn with experience and as many years as you've done it is, okay, well, give me you can foresee problems that aren't even there.
Yes.
And say, okay, I'm going to need to see this, I'm going to need to see that.
Yeah.
So I know we can get past this and we'll have a successful closing, instead of finding out.
We're both blindsided.
Like you said, at the very end.
Stuff that the lender can see, and So I was blindsided by like,
Yeah.
what do you mean? This is,
Yeah.
and then thankfully I reached out to Jason and I explained the situation. The client reached out. I think we had this communication to say, hey, can you help us figure out what's going on? Because I feel like this lender is not communicating anything with us.
Right.
Just to finally get a real answer.
Yeah. And I think that's what you guys as realtors, as your clients depend on, is knowing
Right.
once I find a house, can I actually close on it? And so that, I think the few items on the back of my card that I ask people, it's been the same for 20 years. So it's
Yeah.
the same information, and we can look at those. I can usually tell you pretty fast what the speed bumps are going to be, or yeah, that'll be a no problem, or here it won't be a big problem if we can overcome X, Y, and Z. So I think somebody with experience should be able to tell you those items and explain them to you as why it's going to be a problem, so that you guys can work with your clients or work mutually with the clients with us and kind of get them to the table.
Sure.
So are there any other red flags you can point out when selecting a lender besides like checking their history and kind of checking the transactions that they have done in the past? To their experience?
Yeah, that's a good question. So on that same website, you can see if they've got if they've had any complaints filed against them. The Zillow reviews, the Google reviews, the Realtor.com reviews. All of those things kind of play into that. Obviously, I don't know how to use social media myself very well, so I probably don't have a lot of reviews out there.
Same.
But I think asking around in the community, if you find some agents, you find some clients that have done a few transactions, and you'll usually find if somebody has a good, bad, or no reputation. No reputation's usually better than a bad one.
True.
Yeah.
Very true.
Yeah.
And you've got a
Take that.
good relationship with your underwriters and things like that too on closing. I know that I feel like some of the bigger entities, the bigger banks or nationwide companies, I'm not going to drop any names, right? I feel like they look at some of those dates in the contract, closing date or what have you, and it's arbitrary to them.
It doesn't
You know what I
do
mean?
much.
Oh,
Yeah.
well, we forgot to get this, or we're still working on that. And can you just ask to extend the closing by a week or 2 weeks?
Yeah.
And you're like, no.
Yeah. No, you
Like,
can't. That's,
seller has movers, and,
Yeah.
their stuff's on a moving truck. They've got, everybody makes plans. Like you said, But,
yeah.
so I feel like that is so critical. Like, I want somebody that's going to get this thing closed on time and
Yes.
be
being familiar
paying attention to those
with
dates.
the contract, even before I ever had a real estate license.
Did we mention that? He also is a real
I also do have a real estate license. I don't use it much, but I like to know. I like to know what's going on. I like to know what dates you guys have, what important dates are, what the contract means, and not every state has that. A lot of states, I forget. I'm from Maine, so the contract in Maine was like 5 or 6 pages. It was not, doesn't have the same dates. A lot of flexibility in that, which is, I think, why you run into that with big box lenders. It's because they're doing business in multiple states, which I can do
makes
as well.
sense.
But if you, without looking at the contract and knowing the contract, you're at a bit of a disadvantage when you're trying to help somebody that's PCSing, that has to have movers in at a certain date, or repairs done and trades lined up, that kind of thing.
Yeah.
So I don't know. I would definitely say go local, unless you're watching this from a different state, and then use somebody experienced that can actually look at a contract.
Yeah.
That and with like you said, the nationwide big box lenders. What I have experienced for my clients is it's like a call center. You have somebody that takes the call, processes some of the information, and they send it to somebody else, and there's no communication. Because I had another one another lender had to jump in and end up taking over because of this big box lender.
Yeah.
Because they were saying, okay, well, we don't need that, everything's going to be okay. The person on the front line doesn't know everything that they're going to need, but they're telling the client that, everything's going to be good. Then, of course, somebody from underwriting's like, well, no, we need this.
Yes.
And causing such a big headache.
Yeah.
And it's
Right.
just, it's operated like a call center is how I feel.
Yeah.
And you don't know who you're going to, you're not just going to speak to the same person, but everything's being bounced around versus going with somebody local.
Yeah.
You can reach out to our lenders
Yeah.
day, nights, weekends. They're there. Like,
That's what I
I
like.
think I reached out to
Yeah.
you. You were
I
answering
mean-
my call. You were at a soccer game.
Yeah.
You were helping me on Saturday, and then I reached out to you on Sunday after church, and I was like, I'm sorry to bother you again. And you're like, yeah, sure, let me look at this. Let me drive this soccer game real quick for my kids, and then you're still checking it. Like,
Local, yeah.
Yeah.
that's an amazing
Well, that's
lender.
good customer service.
Yes.
You know what I
Customer
mean?
service.
And
That's a good
that's,
person.
I feel like,
Yeah.
well, I like that. Like
Yeah.
you said, I hate calling in and you talk to somebody different every single time. And like
I
you
leave
said,
at 4 p.m. and then
none
I'll
of
get
those
back to you
people
till
are
Monday.
On the
communicating.
East Coast. for
And well, I think that's why you get down to 2 days before closing, and then you're like, oh, we need 2 more weeks because
Yeah.
we don't have XYZ.
Yeah. I think that is something to be said.
So-
Local accountability, that reputation that we were
Yeah.
talking about, I have to maintain that. Not that I don't want to do a good job, but clearly I want to. But I also need to maintain that reputation. If you call around and you find out, oh, yeah, he never answers his phone, he never calls anybody back, we've dropped a bunch of closings, chances are you're probably not going to use that person again. And you wouldn't in any industry, right?
Even the clients get nervous. You know, I've had
Yeah.
people go, Heather, somebody new is calling me all the time. Is this legit? Like, I don't, they're asking me for all this personal information, but it's somebody different every time I pick up the phone.
Yes.
And you're like, yeah, that's a little unnerving.
yeah.
You know?
Yeah.
Just to be full disclosure, like, it's sad when our clients get into these positions, but we cannot pick the lenders for our clients. By law, like, here's a list of different people. Here's people that I work with specifically. I want you to call them, talk to them, get a feel for who you think you can work with best. Ask about their hours. In the end, ultimately, they're going to choose who they prefer, or who they want, and so.
It's funny. We compete against online lenders, other local lenders, national, or whatever it may be. So whenever I'm competing against somebody, I always tell the consumer, at the end of the day, rates are going to be very similar. Costs are going to be very similar, within a couple $1,000s, I'm sure, depending on your price point. But I always tell people, just message that loan officer on a Sunday.
Yeah, exactly.
See if you can get a hold of them, ask them a question, and if they answer it, then you probably have somebody that cares about your transaction that's going to kind of fight for you when you need it. If you don't, chances are the rest of your experience, your buying experience, is probably going to be very similar to that, where you're not going to be able to get a hold of them. And it's unfortunate, because the home buying experience is supposed to be great, whether it's your first home or your dream home or an investment property. It's supposed to be an exciting process.
Right.
And when it's a stressful process, it's not fun for anybody, especially those buyers that are moving and
Yeah.
transitioning. And
Well, like you said,
Anyway.
there's just so many things that are involved in the transaction, right? From beginning to end, and so many things that you need, things that I need.
Right.
And
A lot of things
there's
that
a
can go
tiny
wrong.
bit of stress there already.
yeah.
Beyond
Especially trying to get all
not
the
being able to
documents
get a
and
hold of someone, or
Yeah.
somebody asking you numerous times for the same thing, So
That's my
Yeah.
goal, is to make it easy on somebody. They already have enough to deal with the stress of moving, the stress of buying, all the
Yeah.
all the 20 some pages of documents and the contract that you guys are laying on them, and all the extra stuff. It's stressful enough. So my
Yeah.
goal is to make it easy.
I feel like one of the other things is what the most common misconception from buyers out there is they feel like, oh, I can't buy a house because I need 20% down to put on a loan. But
Educate us home.
Is a great.
that is not true.
That's a great
right?
question. I still get
not
that.
true.
I mean, even I've seen CHFA commercials on TV, and I still get that question. So no, you do not need 20% down to buy a house. So there's tons of programs out there. Kind of the conventional minimum down payment is 3%, but there's lots of programs with down payment assistance. There's our CHFA program here in Colorado Housing and Finance Authority. You just have to have a minimum of $1,000 into the transaction, and then you can buy a house. So, and there's several other programs as well that help you with down payment assistance, with closing costs. We're in a bit of a buyer's market right now, so sellers are a lot more willing to participate in some of those costs. So, yeah, there's tons of programs out there. mortgage insurance has always been had a bad name to it and bad history. But at the end of the day, it's a great way to leverage and not put as much down. You can put 3% down, 5% down, and mortgage insurance has become competitive. So it's a great way to leverage your money somewhere else and do a small down payment, help those first-time home buyers get in. The income-based mortgage insurance right now is huge. So depending on where your zip code is, what income level you're at, whether you're a first-time home buyer, that mortgage insurance is incredibly inexpensive compared to what it used to be.
Oh, so it's completely changed then.
Completely changed from where it used to be, right? Yeah.
Wow.
So it's a great...
That is good to know. That makes a big difference.
Yeah. And I'm not a CPA, so I won't say anything about its tax deductibility. Yeah. So, what else do we have on here?
A review of the loan program.
Oh my
Yeah,
goodness.
there's so many different loan programs. I mean, you talked about down payment, but
Yeah. So, actually, that's a good one. This just came out. I can't remember the exact number, but you talk about down payment, minimal down payment. The conforming loan limits right now, as of January 1, 2026, will be changing to, don't quote me on this, call it $835,000. So $835,000. You can do as little as 3% down on a loan amount to $835,000. And that is different in Denver. Some of the other counties, some of the higher cost counties are even higher than that, upwards of 870,000. Even Surveil and Summit County, that's upwards of over $1 million that you can put as little as 3% down, if you qualify, of course.
because that's different, because then there are the jumbo loans, right?
Yep. So anything
For
above
increased
that dollar
payments,
figure.
do those require more down?
They generally
Typically?
do. Yeah.
Yeah.
So with a conforming loan, the conventional loans, that's going to have some government backing. So the Fannie Mae, the Freddie Mac that you hear about on the radio, the Ginnie Maes, the government-sponsored enterprises that we all pay for. That is all going to be insured and backed by the government. So when you get outside of that realm, then you get into what's called a jumbo loan, and those are more bank-specific, investor specific. You can edit that, right? Tongue-tied.
We like bloopers. It's all right.
Yeah, that's right. So investor specific requirements. So if you've ever done one of those, usually they're 20-25% down minimum, and then their underwriting guidelines are a bit more strenuous. So,
But you can buy a lot of house for
You can
$835.
buy a lot of house
As a matter
here.
of fact, you can buy a
Yeah.
brand spanking new one for less than that. These builders are offering some
3%
really
down.
good
The
incentives.
incentives they're offering are fantastic.
Yeah,
So yeah, it's
absolutely.
great. So
Do you have a favorite mortgage program? I mean, I think, darn, all of us like, woo, VA buyer.
yeah, exactly.
But-
It's ironic. Yeah, it depends on the time.
Not everybody has access to VA,
Not
so,
everybody does have access to VA. And if you asked 5 years ago, any realtor in town, VA wasn't on the top of the list for being accepted. So
give us the pros and cons, maybe like say there's conventional with 3% down, and then
Yes.
of course FHA, that's 3.5% down. So that's really minimal differences, but
Right.
so what are some of the
that's
biggest differences, pros and cons of going conventional with 3% down or FHA with 3.5?
Well, that's a good question. So, the difference between the two is going to be the biggest one is credit score and risk, right?
Yeah.
So, FHA has a lower minimum credit score, allowable credit score. So, if you've got, sub 620 credit scores, actually that just changed, sub 600 credit scores, then
okay.
you're probably more likely going to fall under that FHA realm if you've got some credit dings like foreclosures and things like that. They're a little more forgiving with that. Now, the cons of that, of a FHA loan versus a conventional loan, is the mortgage insurance. So FHA has a huge 1.75% upfront mortgage insurance premium.
Yeah.
So that you can recuperate a little bit of that if you refinance. I don't want to get into the weeds too much, but
Sure.
the monthly mortgage insurance, unless you put 10% or more down, is there for the life of the loan. So when you look at amortization schedules, that gets really, really expensive. So with a conventional loan, conforming loan, that mortgage insurance, you can do a few things to make that go away. It'll go away at 70% of its initial purchase price, or you can take some steps to reevaluate your home to get rid of that mortgage insurance without having to refinance.
Okay.
So when you look at amortization schedules over time, kind of have to weigh which one is better.
That's right, because that's a change too. It's not super new, right?
No, I mean, it's been like that for a little while. And
Yeah.
that has varied over the years, what that monthly mortgage insurance for FHAs look like, and
Because you used to be able to get
premium.
rid of it on an FHA mortortage too.
Used to, yeah.
Yeah,
I forget
now
what year that
You're,
changed. but
the only way
in
to
the
do
last
that is
5
to
years.
refinance into a different loan.
Yeah, if you do, and even if you do put 10% or more down on an FHA loan, your requirement, it's absolutely required regardless of your equity position for 11 years. So
Oh, so you could put as much as
you can put 25%
20% down or
and
something,
you still
and
have that
you're still
mortgage
paying
insurance for
mortgage
11
insurance
years.
for 11 years.
Yeah. So yeah,
Yeah.
and so a lot of people,
Okay.
the pros and cons of the government loans, so the VA loans, the FHE loans, it's MPRs, minimum property requirements. So that's what most agents are going to look at when accepting or making offers, and those minimum property requirements are things that the government has basically spelled out to say your property has to meet certain requirements. You need
Yeah.
no peeling paint, no no
We got
exposed
caught once on
electrical.
the concrete on
Yeah,
the sidewalk
trip
was off
hazards.
enough, trip hazard, you
Yeah,
know.
that
You're missing
is-
a hand railing.
Yes.
You
So
know.
we see a lot of that. And actually, when the market was really hot here a few years ago, I saw a lot of agents that wouldn't accept VA as an option. And I'll tell you the
Yeah.
story of a friend of mine. It was a doctor buying a house, $1.4 million, and they did not have VA as an offer. They wouldn't accept VA offers because of everybody's misconception of minimum property requirements. They didn't want to have to go through the appraisals and all the extra stuff with
Yeah.
a government loan. So when I called, explained, it's a doc, there also is a perception that they don't have any money, right? Because they're doing 100% financing, they don't have any money. Not always the case, right? They could be a doctor and they could make plenty of money and have enough for a 50% down payment, but
Yeah.
choose to get a 3%, 2% rate at the time, and finance 100%. And so once I explained how those minimum property requirements could be addressed, if there were, and this was, I think, a Cascade home, something, Wood Avenue, some
Oh,
those
yeah.
old, the
Oh,
old
yeah.
homes that always have a few
Those
issues, but it's been remodeled, so it wasn't a problem. But anyway, once I explained that, they accepted the VA offer for the
Nice.
doc over 3 other offers. So
That's awesome.
Yeah.
Yeah.
And that's important too, because sometimes
That goes into the
your
first
lender
question.
picking up the phone and talking to the other real estate agent,
yes,
taking the time to do that so that they feel secure.
Yes.
This transaction's going to go well. This person knows what
Yeah.
they're doing. That's important
Yeah,
too.
That goes into your first
Get a home
question.
that you
Yeah.
want that could
Experience
have otherwise
loans or-
been, another lender could have been like, sorry, there's just, we got to go with something else. You
Yeah.
know, like,
Yeah.
that's awesome.
Yeah.
That's huge.
So, yeah. What else
Yeah.
we have?
Yeah, you talked a little bit about the down payment assistant options out there.
Mm-hmm.
Are there any others?
Colorado has a few CHFA, CHAC. They are somewhat income based, but somebody asked me this morning, as a matter of fact, and I should have looked that up before I came. What the minimum income limit is for CHFA, and it's in the tune for a conventional loan, down payment assistance 3% down. They can do a silent second for 4%, but your income limit per household is like $130 some thousand. So that affords you, I mean, that's
Yeah.
a pretty good, that's a pretty good income when you look at El Paso County, for example. Our area median income is about $113,000. So a lot of households can fit into that to qualify for that
And utilize it.
and utilize
Yeah.
it. And if you're in an FHA product, similar, 3.5% down, 4% silent second, that one is closer to 165,000. for household income to qualify for
Nice.
something like that. So there's a lot of options out there. And then you've got a whole lot of options, a lot of private options for down payment assistance. So there's a ton out there. Most are income based, but some, if you're in rural areas, so you might have access to a USDA, you might have access to have your income based down payment assistance waived if you're in certain pockets. So there's a lot of different products out there. So
Nice.
before I bore you, there's a lot of them. Just
Yeah.
call one of
Just
these
call
guys
in.
and see what you
However,
got.
free money does
Yeah.
cost you something, right?
Free money. So that's
You
always
know?
a misnomer. We always want to analyze that free money. Yes, free money isn't always free. So it's usually you're going to find those products at a little bit higher interest rate, and we can get into some of those. Whether
Yeah.
there's some grant money, but again, some of that stuff you have to pay back. There's equity share programs. There's
Well, and that's why I tell people, because buyers, what is my first step? Where do I start? Start by talking to you,
Yeah.
right? Because that's huge. If you don't have a down payment or you want to look into down payment assistance, if you're trying to stick to a budget, like you can look at every single loan program that's available to them.
Yeah.
You can crunch all those numbers. You can spit out payments for all the different ones, what your payment look like at a CHFA rate versus the regular conventional mortgage insurance, no mortgage insurance, all of those scenarios, right?
Yeah.
So that they can compare them side by side and figure out, okay, which one of these is
Yeah.
the best for me?
Yeah.
What do I want to go with and what do I need to prepare for?
and which
You
one's
know.
best for right now? Which one's
Yeah.
best for 5 years from now? Which one's best from 10 years from now?
Yeah.
Just saying everything that a lender should do, that is why it's 100% important to pick a great lender, a local lender, somebody that will
Yeah.
put in the time and effort, because
Right.
some do not go through that extreme at all.
Yeah.
They just try to get you locked into something to get you locked in.
Yes.
Yeah.
That is something I should probably mention that too. A lot of people ask me, how much do I qualify for? And that's a different answer depending on your product, right? So some products allow for a higher debt ratio, some products are higher rates, some products have higher mortgage insurance, and some products maybe you're going to if I say you qualify for a $300,000 house, but then you go look for a condo that may or may not be able to be financed through FHA or VA or
Right.
conventional, and then you've got an HOA that's, when I look at the other day, I think the HOA was $695.
Astronomical
So
lately.
yeah,
Oh my
so
gosh.
that
Some of
changes
them
the
are big.
profile of what
Yeah.
you qualify for. In addition to, I always ask people it doesn't matter what I tell you what you qualify for, but
Yeah.
what do you want to make for a payment? What's outside your comfort zone? And once you can determine that, then I can work backwards into what product is going to be better, which ones are available to you, which one's going to work best for you. Because if I tell you you qualify for a $500,000 house, but you want to make a $1,200 payment, we are not looking at the same houses.
You're right. No,
That's why I tell them, like,
not at all.
what's your, when you speak with a lender, find out, okay, don't think about the price of the home. Think about what are you comfortable paying monthly?
Yeah.
What is the absolute maximum amount? And don't go to like your top dollar amount because emergencies happen.
Yes.
Aim low. And then talk to the lender about that estimate so he can figure out what type of house you can afford.
Right.
And that's
I try to do
Yeah.
that is and share in that, as long as the client's willing to let you guys share in some of those presentations to look at payment options and product options. If we figure out what your payment range is, I usually show you a little bit above, a little bit below, so that you guys can have that conversation. Because it's different depending on the market. Right?
And speaking of CHFA and those down payment assistance programs too, I had run into a scenario, probably something you knew, apparently, and I was working with the seller, but the lender that was working with the buyer, once again, didn't ask a lot of questions up front, but that's household income,
Household.
right? So you can have two
you got a
people that are on the
18-year-old
mortgage, two
kid.
people that are on the contract to buy the house, right? Yeah, but your 20-year-old son is living under your roof and he has income, that is counting it.
Yeah.
Yeah.
USDA does the same.
We got about a week before closing and the lender goes,
You make too much
I didn't
money.
know that they had an adult kid that was going to live with them and I have to count their income. Now they have no down payment and they don't have the money for their own down payment.
Yes.
And so Yeah,
that
that
is
killed the deal and we had to go back on the market.
Yes, that is a deal killer.
Yep.
That is an absolute deal killer. Now it is. It's
Yeah.
funny because if you go to the conventional loans, the 3% down payments. If you happen to have your own 3% down, they only use what income you put on the application. So if your income meets, like say spouse one meets the income limit for that product and you get a reduced rate, reduced mortgage insurance, then we only use that income. But if you try to do that with a CHFA loan, it's the entire household.
Yeah, it's
So
everybody.
It is. And the other one that burns people too, that I see all the time, I get this like oh crap phone call, is childcare for VA. So VA has some rules. You've got your debt to income ratios that you have to contend with, but then part of that is what's called a residual income. So VA puts out some guidelines for residual income based on your household size. And so depending on the square footage of the home, the household size, you have to meet these guidelines. And so what happens a lot of times is that people don't ask what your child care cost is. And so you get all the way through, your debt ratio looks good, and then all of a sudden they go, oh, well, we see $1,000 a month coming out of your bank statements or on your LES. What is that? Oh, that's my child care. And child care gets factored into that residual income, and you get burned.
Okay, just like anything else.
So, yeah. So when you see, and certainly whenever I see dual incomes, that's when I typically will
ask about childcare
verify
right up
that,
front.
yes.
Right up front. Yeah.
If you don't see dual incomes, then it's usually less of a factor, or age of the dependents. But anyway, that's where experience
And then
comes
as
in.
far as qualifying, buying more money too, there are certain loan programs out there that will actually, if you can get enough from the seller and seller concessions, which right now is actually a really great time to do that.
Yes.
I've seen $15,000, even $20,000 people are giving buyers and seller concessions right now.
Yes.
But they could take that and use that to pay off existing debt with some of the programs,
Yep.
which might help them
Qualify.
qualify, that might bump their sales price up by $50,000 or
Yeah.
something.
So I use the rule.
Which programs are,
a little
can
harder
you
now,
can
but-
you do that with?
That's a great question. So first off, you have to be cautious of how much you get. I had that conversation with one of my loan officers this week. That unfortunately, the realtor had done a great job negotiating seller concessions,
Yeah,
but they were about $4,000 high from what fit the limit.
yeah,
So with FHA loans, you can use 6% of the sale price towards seller concessions. VA is 4%, and there's some flexibility within that in how you use it. Conventional loans a little different. If you have less than 10% down, it's 3% of the sale price. If you have 10% or more than 10% down, it's up to 6% of the sale price. And if it's an investment property, this bites people a lot.
Yeah.
2%, no matter how much you put down. So
Okay.
2% of the sale price.
2% max.
Don't
on
over
investment,
negotiate
yeah.
that. And then, yes, so for VA loans specifically, you can use that for debt reduction, which is great. So we've used that to pay off the remaining balances of cars, credit cards, installment loans. And rule of thumb that I tell people is for every $50 a month in debt, in payment debt that you pay, it's about $10,000 difference in approval amount. So,
That's huge.
Yeah.
That's huge.
When the average car payment is $660 some dollars, it can be pretty substantial. That is something that I get a lot. Well, I pay $3,000 a month in rent. I can afford X, and that sounds great. Maybe you can, but on paper we have to fit certain restrictions.
You might be physically doing it, but
Yes.
when the bank looks at that scenario, they see too much risk and
a little
say
too
no.
much risk. Yeah. So, which is our entire business is just mitigating
Managing risk,
Yes,
right?
That's
Yeah.
it.
Absolutely.
Yeah.
So,
Do you want to dive into everybody's favorite subject?
What's that one? Amanda?
You know what I'm gonna say?
Where are rates going?
Interest rates, right? That's what everybody's been talking about all year long. Or,
Is,
oh, my phone. I get a daily email
Yeah.
telling me what interest rates are doing. And they
Yeah.
make it sound like they're coming down, coming down, coming down. And I look it up and I go, that's really not any different from what I've seen for the whole last entire year.
it
Like,
doesn't-
what are they talking
they're
about?
not changing a ton.
It's
So-
like I see it up, down, like very minuscule. Just
Right. There's some
Yeah.
fluctuation there, but
Yeah.
it's not
not a
enough to
drastic
make
change.
Yeah.
to make me jump up and down or get
Not at
super
all.
excited or
Yeah.
or change the market here.
The
And
positive thing is, since we've been keeping track of rates historically since about 1971, the average 30-year fixed rate is 7.25. So right now
we're still below average.
still below average by roughly a point, right?
Yeah.
And so when you look at that, that's a positive thing. Home prices are different, so
Yeah.
affordability becomes different, and that's a whole nother animal we can chat about. But in
so
terms
true.
of predicting where rates are going to go, I would.
I would expect you to predict it at all.
Yeah.
Yeah, I mean, anybody that tells you this is where rates are going, I would run away from, because
Yes,
none of
on
us
that
really
real
know,
fast,
right?
yeah.
At the end of the day, somebody could sneeze tomorrow, and like just yesterday, they announced that the Fed's going to start buying some mortgage-backed securities and some equities, and so it could be a very good chance that we'll see some rates potentially go down.
Yeah. Well, the last two times the Fed has dropped the rate, right? We've seen mortgage rates go up,
See the spike.
but that's because that's not the biggest indicator, and all of the what does really play into
Yeah,
what the
I mean, I
mortgage
will-
interest rates are.
Yeah,
There's
I
a
was just
variety
gonna
of
say,
things,
there's
right?
a whole
But
lot that goes into that, and I will not bore your.
yeah, because I
I'll
feel
let
like
people
you know
ChatGPT
the
that
common
one.
buyer, the misconception is, oh, the Fed's just dropped the rates. That means
Right.
I could get a better mortgage rate, and
Yes.
it's like not
Yeah.
right now.
So we are one of two countries that has a 30-year fixed rate. And so to not bore you and get into what mortgage-backed securities are and how that are all packaged and risk of selling, bigger assets, it's basically a hot potato of risk. And that's what everyone's trying to get off on somebody's risk. And that's probably one of the biggest misnomers with a mortgage is people think the risk is somebody not making their payment, but it's more the value of that bigger asset. Not necessarily the house, but the collective asset group. So if rates were to come down tomorrow, like they did back in 2021, every bank would go out of business because they'd have all these margin calls, and it would be a
catastrophic,
disaster.
right?
Very catastrophic.
Yeah.
So my prediction, call it what it is. You can listen to 10 different people tell you 10 different things, but at the end of the day, most likely we're in a trading range that we're going to see probably for the next 2 years would be my guess, give or take a half a point on either end of that. So, which doesn't seem like a lot, but when we saw rates drop or increase 3 points in a matter of 6 months, that's a pretty marginal range.
Yes.
So
Yeah.
So, but I don't think we're going to see.
Drastic changes.
If we see 2% again in my lifetime, I will be absolutely amazed. So, call me. I'll give you that rate.
Right? We can all hope and
Yeah.
pray, but that's probably not coming back around
Yeah.
for who knows,
Yeah,
if ever. So,
yeah. So, but we said that about the sixes too. So,
and here we are.
and here we are.
Here we are.
So,
I really want to get down into like at least 5.5.
yeah. I thought
feel
6-7
like-
was going to be good, but
Hey, my kid loves 6'7".
my kid's going to see that. Shoot.
Oh my gosh.
Yeah.
Okay.
So I'll ask you, what makes a good lender? That is something I ask agents all the time.
Communication, like the top thing for me, as I've learned with my clients, is that communication.
Right.
It's open communication. It's somebody that is willing to like say answer the call on a Saturday when they're with the kids at soccer, or help you with an emergency. Somebody that is knowledgeable about the market and is willing to actually sit down with the clients and, hey, this is your budget, this is what this looks like, these are the different options that you have, these are the different loan programs, let's see where it fits within your trajectory of buying a home or where you want to be.
Right.
They're client focused and they're people oriented, and they're actually trying to do it in the best interest of trying to help somebody and for that person. Like it's good morals and values to me. Is that
Right.
that's the number one thing.
Those are irreplaceable.
Yeah.
100%.
That is, it's funny because that's a discussion. I mean, AI can pretty much do my job all day long. I mean, it's, I'm fairly...
They can right up until the time that there's a problem they don't know how to deal with.
Error.
You know,
So that is
I don't know.
Network problem.
You seen the self-driven car that like drove
goes into an
right
accident.
through? It was a police barricade. They had guns drawn, guy on the ground, and the car just turns right through.
Yes.
Like,
That's how
you
your
know,
loan is gonna
that's
go
how
for
your
you.
loan's
Yeah.
gonna go.
That's-
Yeah,
yeah,
like
well.
I mean, if it's smooth, it's smooth, and
Yeah.
if you hit a hiccup, it's gonna go. I don't
think
know.
that's. I ask that question
Yeah.
all the time because that is. I feel like I'm going to be obsolete for the most part for 80% of the buyers that are watching this. But it's the ones that aren't, the ones that do need that help. That's where we kind of hope that experience and the education and just the ability to foresee some potential problems. Hopefully, we stay relevant. We stay relevant as loan officers for that very reason. Those of us that have some experience.
I think like another thing that is like a flag for myself is it's like what they call realtors sometimes, like people with commission breath. Like they're
Yeah.
like talk about,
Yeah.
I do this, and I'm the best, and I'm the best at this, and this is why I'm the best. And I'm like, really? Like, I just, that for me is like a huge flag. And that's coming from like an experience I had with somebody that clearly defined that they are not the best, you know? So it's stuff like that is just a really big flag for me.
We didn't require a license, I think, until, I can't remember if it was 2007, probably 2009, I think it was, when after the crash.
Yep.
So you didn't need to hold any kind of license to provide this kind of financial.
Isn't that crazy?
Yeah.
That is crazy in my opinion.
I always
Like,
thought it was nuts
it's
too.
so much money on the table, and just anybody could do it.
Yes.
Yeah.
So yeah, back in the day, like I said, early 2000s, I started doing this and didn't need a license, didn't need any formal training, didn't need any oversight. You really didn't need anything other than a phone. And the evolution to needing licenses, now needing continuing education, and a lot of that stuff I appreciate because it weeded out a lot of the people that were just in it with commission breath that didn't really have the client's best interest in mind, or just an educational mindset there was not a lot of that back in the day. So it is nice. I appreciate it from that standpoint that I appreciate working with agents that also have that same
Just gotta remain humble.
same mindset.
Yeah.
So it's not about that deal. It's
Well,
about
and somebody that's willing to explain things thoroughly too, and make sure they
complicated.
understand it all.
Yeah.
Even
Like that's huge.
somebody that they're not getting paid for that transaction, and they help you and your client out that are dealing with somebody else, and like, what a godsend. Like,
you got to be a good steward.
and
for the
someone that's
industry.
willing to jump in there and help. You know what I mean?
Give
Because
you
like
answers.
we're not all the same. I know I've had some dealings with some elderly clients, and I mean sometimes you have to drive to their house or have them come to your office. You have to sit down with them.
I just sat at a kitchen table for a reverse mortgage yesterday.
'Cause they're going,
That was
I can't
collecting
DocuSign
documents.
this. Like it's
Yeah.
not working. I can't get it done.
Yeah.
You know?
Person.
Yeah.
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 And I've literally had clients go, you know,
It's too much.
this person, they wouldn't help me at all.
Yeah.
Like, wouldn't help me at all.
Unfortunately, there's enough of us
And you
out
know
there
what
that
happens
you can
is
find
that I had to
somebody.
call you. I had to call my agent. You had to come over and help me figure out how to do it,
Right.
and how to get
Right.
how to get all my stuff to the lender. You
Right.
know,
Which at the
'Cause-
end of the day, that's not
yeah.
what you got to. You want
Yeah.
to be helping them through the different aspects of the transaction, not the finance piece of it,
Yeah.
right? Yeah.
So, do you want to touch a little bit? I don't know if this will upset anybody, but like the idea of the 50-year mortgage?
Oh, man. I wish I had my computer up.
Right? Are they still talking about that? 50? Are they really going to do it?
I don't know.
I hope they don't.
I don't think it's
I hope
a
they
great
don't.
idea.
It's a great thought process.
I see where they're coming from.
From
with
affordability.
prices being as high as they are, with trying to make it more affordable, but
Yeah.
like we all
Honestly,
talked about it, and it just seems
Think about it
like
for 50 years and the price that
a
you're paying.
bad idea
Yeah.
when you look at it over the long term.
Yeah, when you run amortization schedules for 15 year, 20 years, and 30 years, I probably can find it on my phone here, because I did run it on about a $500,000 purchase price, but it's over $1 million in interest that you pay between a 15-year note and a 50-year note. It was over $1 million in interest that you would pay different.
So you
between
pay buy a
those two.
$500,000 house if you had just financed it for 15 years,
Yeah.
That's what we should really
and then
talk
you're looking
about
at
more.
40 years
Is the
or 50 years,
Let
an
me see.
extra
Let's see if I
35
can find
years.
it. Yes.
You're
And-
paying $1 million
Yeah.
in interest payments. Ouch.
It's big.
So I get a lot of people talk about 30. Like, I think
Yeah.
15-year is, I mean, I know it's tight, but if you can budget some things that you don't need in your life, honestly, wouldn't it make more sense to pay it off in 15?
It is a budget breaker to do
Yeah.
a 15-year oftentimes, but it's, again, not to get
Yeah.
into specific numbers, but on a $500,000 house, it's probably no more than a car payment to do a 15 over a 30, or even look at a 20, do some bi-weekly payments. But when you start looking at that interest that you're going to pay over time, it's an absolute huge difference.
It is. Yeah.
And when you look
Yeah.
at it versus cars are expensive these days. Let's just face it. You're paying $40,000 for the basic car out the door, and a lot of them are 60, 70. I saw one the other day that was, I think it was a Ford, but they financed about $90,000.
Oh my.
And so, that had a $1,300 or $1,400 payment on it because it was a 84-month term. So, yes, not to get on my soapbox of prioritizing
Good gracious.
where
Right.
your budget goes, but yeah, if you started to look at that in terms of could I put that into the house or put that into a car,
Yeah. Let me buy a beater upper and just put this into the house and have a paid off
Yeah.
house in 15 years.
and that's maybe not what everybody wants, but
Yeah.
I
Or,
do get that pushback a lot.
I know I did that, right? Because in this industry,
Everybody wants the shiny.
things can change from one year to the next to the next to the next. And so I refinanced, did a 30-year mortgage, but I was like, this gives me the flexibility when I'm having a good year. I'm paying an extra $400 towards
Yes.
my mortgage
Yeah,
every
which
single
is
month.
amazing. That's okay.
And if the market tanks and
Yeah.
it's a little bit, my budget's a little bit tighter, well, then I have that. I can just make the minimum payment
Yeah.
if that's what I
I
want to do.
don't knock it at
The
all, like
regular
20,
payment.
30, I don't knock those at all. I just
Yeah.
think that people don't know about the 15-year and they're not
They're not
educated
thinking
on
about it.
enough. Like,
Yeah.
here we're going to push this 50. Let's educate you on this 50-year mortgage
Right.
instead of, hey, listen, here's different. Like, here's the 15 one. Just
So I
thought.
think that is
Yeah.
probably, you said educate you about this product. I think that's probably where what happened in the crash was that people were not educated enough.
Mm-hmm.
So there was a
Yeah.
product out there, you may remember
Oh,
this one, but
goodness.
the pay option arm.
Negative
Negative-
amortization
yeah.
loans.
Which isn't always
Yeah.
bad. I mean, so if I had one right now, I would love it. I would absolutely love it right now because the last few years, anybody commission-based, our income's dropped pretty substantially. So what the pay option arm was basically you did a loan, you got your monthly mortgage statement, and you got 4 options. One was a 30-year fixed payment. The next was a 15-year fixed payment. The next one was an interest only, so only paying the interest that you owed on that month. And then the pay option arm part of it was the difference between the 30-year fix, the principal and interest between that, and the lowest payment possible, and they would add that back to your principal loan amount. So for me, would have been great. last 3 years would have been great. My home's appreciating at a better rate, but I'm commissioned. That's not good for somebody that is on a fixed income, a Social Security, a pension.
Right.
You know, that flexibility doesn't work for a lot of Americans buying a house that are on set incomes. So the 50-year kind of does something similar. So where we had a lot of interest-only payments back then. So what would happen was you'd buy a house for, back then it was like $150,000, and you'd go to sell it 5 years later, and they owed still $150,000.
Yeah.
And so now I can't sell it, or I have to short sale it, or come to the table with the money, and unfortunately, people didn't budget well. So
Right.
we ran into that problem. So here, I found my little presentation, so let me see if I can tell you. So the interest paid over 30 years, over 50 years. So that was a $500,000 home being financed. You'd pay on a 15-year interest rate around 6%, about $240,000 in interest on a 15-year. If you did a 20-year, that interest you would pay was about $340.
Yeah.
If you did a 30-year, the interest you'd pay is about $550. And if you did a 50-year note, the interest you'd pay would be $1,001,000-ish.
Wow.
Yeah.
Wow.
So it's a lot. With a monthly payment difference only being about $1,300 from a 15-year note to a 50-year note.
Well, and that was the thing.
A 30 and a 50.
Yeah,
There's
the
only
gap
about
between
$200.
because most people out there, right?
$200 to $300 a month.
So yeah,
So is that really making it more affordable? It's a good question.
you're doubling what you're paying in interest, and really it's only saving you $200-300 a month.
Yeah, bad investment on my point of view.
Yeah.
I
But
agree. My own
So-
opinion.
yes, yes. So everybody's entitled to those. But so we'll see. We'll see
Likewise.
if it hits. I
Well,
don't
and
know.
that's the thing too, right? Life happens.
Yes.
Life happens. We can make the best plans and everything else,
Yeah.
but if you get into a 50-year mortgage and you think, okay, I'm okay because I'm gonna own this house till I die,
Yeah.
and then 5 years down the line you need to sell it,
Yeah.
Yeah.
it's going to be you can do a 30-year loan or whatever, and it's 5 years down the line you're probably just fine to sell it, pay all your fees, even make a
Yeah.
little bit of money. But on that 50-year, you're not going to be
Yeah,
able to
that's
do that.
Yeah.
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 So
Yeah. Monthly budget. That's something. Do you guys do that as realtors? Help people with their monthly budgets?
yep. That's my jam.
Yeah,
I mean, I
think it's
should
great.
have gotten into your job, to be
I know,
honest.
right? I was gonna say,
Like,
yeah, a lot of times that's
sometimes I think about that. I go, I think I miss my calling. I love real estate, but I really love crunching numbers.
The numbers.
I
I'm more of a
do.
numbers
I
nerd.
do. Yeah.
I
Yeah.
think that's really important anytime too. Like I do
So-
specifically leave a lot of that for the lender when they're looking at all because that's
Yeah.
almost like, listen, your credit score, you're like, that's your private information. Like you don't have to disclose that to me.
Yeah.
That's what you disclose with the lender. You sit
Yeah.
down. I was like, but if you need help with like creating a budget, I think that's the most important thing you can do is like, okay, do
Yeah.
you really need this
Yeah.
subscription? What about this one? And like some people don't even realize half the subscriptions they have.
Yes.
You know. But
Mm-hmm.
I think that's such an important thing. Like when you have a local lender that you work with, you can sit down with your client, with the lender, and you guys can all go through that and have an understanding
Yeah.
of what that looks like. So
Yeah.
you have not just the lender staying on top, like, hey, did you do this? Hey, how's your budget been on your eating out?
Yeah.
You have
Yeah.
both people trying to help that person. And
And I'm
think
sure
that's-
you and I both, we're totally willing to do that. Like,
Yeah.
let's
Yeah.
have
Yeah.
you, me,
Yeah.
the
We love
buyer,
helping people,
sit
like,
down
let's sit
together.
down.
Yeah.
Look at everything.
out.
Like I
Having
said,
everybody on the
they can
same page
help you
is
figure out.
critical.
Like that's one of the biggest things is that let us sit down with you and help you figure out what you should pay off first,
Yeah.
right? Which balances, and look
think-
at the interest rates on those
Yes.
things, and kind of guide you
Yeah.
so that you're really maximizing what you can do in the shortest amount of
Yeah.
time.
Right. Right.
You
Yeah, I
know,
think that's
if you're not, mortgage ready today.
Yeah. I think
So-
that experience on not just our side, but your side too. I've had a lot of those conversations in the last few years with a lot of new builds being built, and I'm getting a lot
Yeah.
of those. Can we refinance to a lower rate? Can we do this? Because nobody explained the taxes the tax piece of their budget, right? So when you're
Yeah.
looking at those monthly budgets, a good agent's going to sit down and go, okay, well, you're buying this new
Right.
build, but the taxes you see are not
Here's
what
your
they're going to
taxes,
be.
and that's on raw land.
Yes.
So
Yes.
next year,
Having somebody like
Yeah.
you guys that sits down and have those conversations is absolutely critical.
yeah,
Keep people comfortable.
yeah, because that blows my mind that nobody
Drives
would
me nuts.
explain that to you. It's like, no, all the other taxes in your neighborhood are paying $3,500 a year. You know, so
Yeah.
that's close to $350 extra dollars a month that's going to get added to your mortgage when that finally rolls
Yes.
over and kicks in, and
Yes.
it's not based off of raw land
Yeah.
anymore.
But people don't
Yeah.
have that conversation if they don't dig deep with their clients and have that personal
Yeah.
conversation. So
So yeah. Well, you guys want to do a recap? What are your final thoughts?
go talk to a lender.
Yeah, call a lender. Yes,
Yes.
call a lender.
Yeah.
A reputable.
Why do you
good,
think
honest
people are
lender.
so afraid to do that? To be honest, you know, because
You know what it is? It's credit reports. People don't want to expose their income and their
Yeah.
dirty little secrets of what's on their credit.
Dirty little
Yeah.
secrets. Yeah.
because I
At
feel
the end of
like
the day,
you
I'm
know,
not
I mean,
judgmental. It just
And
is what it
should be-
is.
It's okay.
it really is the
Scary,
absolute
but-
best place to
Yeah.
start.
Like,
But
don't be scared. They're
I
generally
get a lot of
down.
resistance when
Yeah.
I'm like, well, let's go talk
Yeah.
to the lender.
Yes.
Yeah,
It's, yeah.
So-
It shouldn't be. It shouldn't be scary. Just
Yeah.
the numbers are the numbers.
Yeah, and even
and
if you're
nobody's here to judge anybody either.
Yeah.
Like,
We all live
absolutely
life.
not.
I'd rather have a,
you know,
I'd
I've
rather
been
have a
through life.
difficult conversation with somebody
So-
up front than a hey,
I've
you
been
can't
through
buy
my
that
ups
house.
and downs.
maybe something we don't want to disclose. I know that, heck, I went through a divorce. Then I had a terrible car accident. I almost lost my house once. Like, I was able to modify my loan with my lender, and you know what I mean? I racked up almost $10,000 worth of credit card
Right.
debt. I had medical bills. You know, it took a plan and it took time.
Yeah.
You know, and so no, it's a judgment-free zone.
Exactly.
But it's a whole lot easier to get to where you want to be if you sit down with somebody and you formulate a good plan.
Yes.
Yeah.
Absolutely.
Yep.
So
It's just taking that first step, right?
Yeah. Mm-hmm. Yep.
So-
No judgment on my side.
Nor mine. Go ahead.
Yeah, just cost. The credit reports used to be $12 and now they're $120, $130. It's ridiculous.
Oh, are you kidding?
I wish it was.
Oh man.
Yeah. I will
Wow.
tell you that too. If you trigger leads, that's
Mm-hmm.
been, have you guys heard that topic, trigger leads? So when you have your credit pulled, the 3 credit bureaus, Equifax,
Oh, they blast it
Experian.
out and you get 1,000 calls?
Yep.
Is that what the, okay, yeah.
I mean, literally 70 to 80 calls within
Yeah.
minutes of having your credit pulled.
have
So they're
heard that.
selling that information to lots of lenders, lots of, you know, they have everything about
And
you.
it's the
You're
credit
telling me about
bureaus that are doing that.
Experian, TransUnion, and Equifax.
I feel like we need legislation to stop
It's-
that.
It has.
That is
but it won't.
insane.
It will trim it down.
Yeah.
Starting this year, but it won't. It won't go away.
Yeah.
Unfortunately.
So expect hundreds of calls from probably
time you
very
meet.
inexperienced lenders that
So even
they
worse,
might talk a good game.
even worse
But,
than that now, they're getting.
they're not gonna-
I just had some clients tell me they're getting text messages saying, "I'm from Jason's office. Here's a link. Upload your stuff."
What?
So that's the level of fraud that you're seeing now.
Oh my
You know,
goodness.
Jason gave you the wrong link. You, like flat out using our name to do that. So be just whoever you talk to, just be very cautious.
It's
Yeah.
wild.
So
Wow.
yeah,
Yeah. Talk to you.
I would love that. That's
Jason
fine.
Twitchell.
You call me anytime.
Yes.
Yeah, you can call me anytime.
What's your number?
Yeah, exactly.
Go ahead.
You can run it
Go
right
ahead.
here. There you go.
Yeah,
That-
Rob will
Tell 'em your
probably
number.
put it
Yeah,
on,
yeah. You can run
We'll
it.
do it
That's
for you.
easy peasy.
But yes, I think it's typical, really and legitimately, it is one of the most important
Right.
things when it comes to buying a house is
Yeah.
to find yourself a really good, really trustworthy lender to work
And there's
with.
a lot of them out there. And I don't want to
Yeah.
just pitch myself. There are, I know
Humble.
a ton of good lenders here in town, across the country. I can refer you to somebody in almost every state, although I can do those loans now. But
Yeah.
Yeah, because you're licensed in.
but if you want the local guy or girl, I have friends in a lot of different states. So, but yeah, there are a lot of good ones for bad one. There's a few good ones. So
Yeah.
I should have
with
said that
realtors.
backwards. Yeah.
So true.
Yeah.
So,
So true.
Did I hit everything you guys wanted? Did I miss anything?
no, I think you nailed it. I
We can
think
Yeah.
get
it's
into
awesome.
some.
So, give us some feedback. What
Gross.
you guys thought. And, you want
Yeah.
more detailed information, feel free to reach out to us, and we'll definitely sit down with you.
Yeah.
And, I mean, we love. I think all of us do. We love helping educate people. We just love helping people. So.
Yeah.
Yeah.
I
That's
love
why we
that
stay in
too.
this business, right? To help people.
Yeah.
So,
Yes.
So, well, thank you so
everybody
much for
Thank you
coming
guys for
and
having
talking
me.
to
Yeah,
us
thank
and
you.
talking to
Appreciate
everybody
it.
out
Thank
there,
you.
explaining mortgages.
yeah. Yeah.
All right.
Probably confused more people.
No.
Like, oh my
Like-
God, that's ridiculous.
Never.
Save them.
Yeah. Yeah. I do a whole lot of that, a lot of saving deals.
Yeah.
So,
Appreciate it.
Yeah.
So,
Yeah.
Helps a lot
Yeah.
because it still makes homeownership possible.
right. Anytime.
Awesome.
Absolutely.
All right.
All
Well,
right,
thanks
y'all.
again.
Thanks, guys.
Thanks for checking us out.
We'll see you next time on Sold Sistas.